Right, so time for another market update. It's the 30th of January, I believe. 31st of January, so just before February. Adam Khoo over here. So I hope you've been following my videos over the last couple of weeks, and basically I'm just doing an update about where the market is right now. Am I long, am I short, and what do I expect moving forward? So back in October of last year, we had the reversal of trend from an uptrend to a downtrend or bear market, and the market from the top was down 20%, and after that sharp move down, we call that a parabolic move. Whenever you see the market moving 90 degrees down, that is usually signaling the potential bottom, right? Market can only bottom when there are no more sellers left, and there are no more sellers left when the last few people holding have sold. And that happens at a point of maximum panic, at the point of maximum pessimism, and it's usually shown during a 90-degree plunge. So every time when you see the market on a downtrend, it goes down a 45-degree angle. And when it plunges at a 90-degree angle, that's usually the sign that the bottom is near. And what you want to see is you want to see some kind of bullish candlestick pattern to signal the reversal. So we had this big bullish candle after this bearish candle, and we call that a wine white soldier pattern, right? So that signal the start of the rally up. Okay, now if you've been following my previous videos, at the point of time as it was going up, let me just show you what I'm referring to. Yeah, so when it was going up, right, so I had a video that said, okay, is this rally a dead cat bounce? In other words, are we expected to bounce temporarily, hit a resistance, and continue the bear market, or at least form a double bottom before the bull market continues, right? So we were looking at that in the previous video, and I said at that time that this level to about 2006, this level over here, that was the potential resistance level. Right, reason was because at the time you can see right, so that coincided with the 61.8% Fibonacci retracement level. It coincided with a previous horizontal resistance that was previous support. So previous support here could become potential resistance. And it also coincided with the 50 moving average. So I said at the time, as the market moves towards 2600, it could potentially reverse back down. So that was a level of resistance. So what happened was it did not reverse, right? In fact, the market broke through that resistance. And remember, once you break through resistance, what happens? Resistance now becomes support. That's right. So now this level 2600 is now the new level of support. So always remember that in trading or in investing, we never predict the market. We always follow the market and wait for confirmation before taking an entry. So at the time as it was going up, I was anticipating to short the market. But I had to wait for a bearish candlestick reversal to short, which did not happen, right? It was bullish all the way. There was no bearish candlestick pattern. We didn't have a bearish pin bar. We did not have a bearish engulfing. We did not have a one black crow pattern, right? So I held my long position, and in fact, doing pretty well. My account is up about over 25% since then. It's one of my accounts. Let me just take a look. Yeah, sorry, no, it's up about 29% over the last month or so. Yeah, that's about it. All right, yeah, so the account's up about 29% since then, all right? And right now, where are we? Where are we right now? So right now, like I said, this level over here is the new level of support, okay? And we have broken above that level, so now I continue to be short-term bullish. Now, bear in mind, officially, we're still in a major downtrend. As long as the price remains below the 200 moving average, the red line, it's still a bear market, okay? As long as the 50 moving average remains below the 150 moving average and they're sloping down, it's still officially a bear market. So we are still officially on a short-term rally on a medium to long-term downtrend. So we are not exactly totally in a bull market just yet. But I'm short-term bullish because we have broken through this level. Now, question is, at this level, I'm still bullish. Where's the next level of resistance? The next level of resistance would be here, because this was previous resistance. This was resistance. So this is the 2800 level on the S&P 500. So I expect the market to go up and test that level, 2800. So right now I'm still long. I've got my long-term investment portfolio. I've got calls which I bought for a short-term trade up. Now I'm going to watch this level again. Now again, at this level, if we get a reversal pattern, we get a bearish pin bar. Again, watch my video on candlestick patterns so you understand candlestick patterns. Really important, right? So we've got a bearish pin bar. We've got a bearish engulfing pattern. We have got one black crow pattern. So at this level, if that happens, I will start to take profits from my long positions. And I would then initiate a short position, anticipating that if this reverses, we could possibly again go all the way back down to make a double bottom. All right, and only after the double bottom will we see the start of a sustained new bull market. As I've shown you in previous videos, very often a market bottoms not always in a V-shaped manner. It tends to have a first V-shape and a second lower bottom. We call that a forced double bottom. So this tends to happen often, but this can happen as well. So if we break above this level with no bearish candlestick pattern, if we totally break that level, then we are going to be in a clear bull market again. And the bull market will again last for, who knows, 6 months, a year, 2 years before the next bear market. So again, we have to see what happens at this level. Right now, I'm bullish till we reach 2800. Again, if we reverse at that level, I'll turn bearish. I'll start to short the market, start to take profits. But if we can break above this level, then of course the next resistance would be 2940. That is the all-time high, right? So that is really important. Again, the market could always go there and do what we call a forced double top and then come all the way down as well. So, as a trader, these are all levels of resistance we are watching. If it breaks, then we stay in. If it reverses, we take profits, we go short, right? So that's how we do it as traders or as in investors. So that's the US market as a whole, the S&P 500. Let's look at specific stocks. Now, as you know, following my videos, I've been talking about specific stocks which I think are great businesses for the long run because they have consistent growth, they've got sustainable competitive advantage, they've got great future catalysts, but they were selling at discounts. They were undervalued because of temporary problems which gave us an opportunity to buy at a discount, right? So remember, that as an investor, you find great companies, you buy them at a discount, but you buy only when the trend shows a reversal. And one of the stocks I've been talking about for the last 7 months, in fact, if you go back to some of my earlier videos, this was when I first mentioned it, that's right, Facebook, right? This was when Facebook had a big gap down because of all the negative news, the data breach, helping the Russians in the 2016 US elections and all those things, inadvertently, of course. So this was back in July, right, when Facebook first had that plunge. Let's look at Facebook. There we go, right? So Facebook, as you know, has been a darling stock for the longest time and reached a high of 218, and then it gapped down, first of all because of earnings, as well as a lot of the negative headlines, right? So at that point, I did an intrinsic value calculation. If you watch the video, my valuation of Facebook is that Facebook is worth about $200 roughly in terms of valuation, or slightly more than that, right? And after it gapped down, I said, hey, now it's undervalued. But do we buy it? No, because it's on a downtrend. How do we know it's a downtrend, right? You can see the 20 exponential moving average below the 40 EMA. That signals a short-term downtrend. And when the 50 cross below the 150, that signals the major downtrend. The short-term trend, the major trend. And during this entire period over here, as you can see, Facebook was cheap, but cheap keeps getting cheaper, low keeps getting lower. And that's why you never buy on a downtrend, because you never know how long the downtrend is going to last. In the short term, the market is irrational. The market is purely emotional. So no matter how good the company is, no matter how cheap it is, do not buy on a downtrend. Always wait for some kind of a reversal pattern, right? So Facebook was at 190, cheap, but went all the way to 120. Cheap became a lot cheaper, right? So I said, don't touch it until we see signs of a reversal. So over here, we began to see signs of a reversal at this point. Can you see that, right? So the downtrend is making lower highs, lower highs, lower highs, lower highs, lower highs, and lower lows. And as long as it's below the 50 moving average, it's short-term bearish. As long as the 20 EMA is below the 40 EMA, it's short-term bearish. Now over here, something changed. What happened? Okay, so what happened was from lower lows, we made our first higher low over here, and then another higher low. And from lower highs, we made our first higher high. So this is a clear change in trend. I could just draw this in, right? So that was trend line like that, something like that, right? So there's a downtrend, and you can see over here, it is a clear change in trend. In addition, you can see that the 20 EMA has crossed above the 40 EMA, and the price has crossed above the 50 moving average, it's sloping up. So this is a very powerful reversal pattern for the short term. Earnings was just announced, and they beat earnings, which I expected, because I said, hey, all these temporary problems are just freaking people out. But the fact is, their daily active users are growing. Like it or not, they are growing. Sales are growing, profits are growing. So great business, right? So since then, I've been accumulating the stock over here, and I've got a slight profit, but I'm waiting for it to go all the way back to the high of 218 and eventually to 250, 300, and it's a great long-term investment, right? So that's Facebook. The other big thing which I've been talking about for quite a number of months, as you know, has been the great opportunity from the trade war. So because of the trade war, the Chinese stock market, the Hong Kong stock market, is dirt cheap right now. It's dirt cheap, right? It's one of the lowest levels in a decade, right? So one of the ways where you can invest in the China market is to use ETFs that are listed in the US or even in Hong Kong, and I buy both of them, right? So the ones in the US, I look at the GXC. So the GXC is an ETF that tracks the China market, the Shanghai Composite Index, right? So you can see again, it was at a high of 123, so a very nice uptrend, and then the trade war started, and it reversed into this downtrend over there. So of course, again, on a downtrend, cheap get cheaper, low get lower, all right? So we had signs of a reversal here. As you can see, this was an initial reversal over there. Right, this was an initial reversal. So what I did was, when I saw this reversal, I started to take positions over there. I started to buy over here. Now, bear in mind that this particular investment in China for me is a long-term investment. So it's not a trade, it's more of a long-term investment. So I don't have a stop loss, because I know that in the long run, it will always go up, because it's the index of the biggest Chinese companies. And like it or not, China is becoming the world's biggest market and economy in the long run. Okay, so it's an investment. I've got no stop loss, and I enter. See, as an investment, you never buy at one go. You do dollar cost averaging. You enter in stages to average in your price. So I started buying here, looking at this early reversal. So what happened after I bought? It went up slightly and it came back down again. We call that a false reversal, and it will happen, right? You can't always catch the bottom. You can't always catch the right reversal. Sometimes you may get faked out a few times, and that's fine if you manage your risk. So when I got faked out, what happened? All right, so whatever I bought there, I just held it because I know it's going to come back eventually. So it made a double bottom. All right, so that's a very nice double bottom pattern. and now it's making a second reversal attempt over there, as you can see. The price has broken above the 50 moving average. It's making higher highs and higher lows. The 20 is above the 40, and I've just added more positions. So I've added over here, I'm adding over here. So this is my average price, and of course I'm holding it for the long term. I expect this to gain at least 30, 50, 200% in the next couple of years. Now, for those of you who are more trading, if you're approaching it from a trading perspective, right, not an investment perspective, a trading perspective, then yes, you got to put a stop loss. You have to have a predetermined risk per trade, which could be 1% or 2% of your account. All right. So if you approach it from a trading perspective, how do you manage your risk? Well, what you do is this: once you see a potential reversal like that, it's a reversal over there, you could buy, right? You could take an entry over there. And where would you put your stop loss? That's right, you put your stop loss below the previous swing low over there. So from your entry to your stop loss, this would be your 1R or your risk distance, right? Your risk per share. So in this case, you can see if you had bought in there, it went up, came down, it would not have hit your stop loss, and you'd be still in the trade. So no worries. Now, what if it hit your stop loss, right? It could have been possible that it hit your stop loss and you would have been a losing trade. You would lose 1R. R again represents your risk per trade. So if you risk, for example, 2%, right? So you would lose 2% of your capital based on that trade. So what do you do? As a trader, you will go in once you see a new signal. So once it stopped you out, if it stopped you out, and now you see, hey, now there's a new entry, what do? You get in again. So you have a new entry over there, and you place your stop loss again below the new swing low, risking again another 2%. Right? So let's imagine you did that, and let's imagine this was another false breakout. Right? Imagine it's a false breakout and it came back down and it hit your stop loss, you're out again. Could that happen? Of course that could happen. So if that were to happen, which I don't think will happen, but if it does, guess what? You lose another 1R, which is another 2% of your capital. Okay? And then what would you do? You just wait for the next bullish signal. So imagine it keeps going down, and then you see the next bullish signal, you go in again risking another 1R. Now let me ask you a question. As it goes down and it has false reversals, eventually would it really bottom? Of course, eventually every market would bottom. Eventually it would really reverse. And once it reverses, what would you do? You will have a monster of a winning trade. So that trade could net you, for example, 5R or 10R, as the index or the market goes all the way back to the high and continues the new bull run, because every bear market will end leading to the next bull market, and that will lead to a potential 20% or 40% return on your portfolio. So you can see that to make money in the markets, it's not about making a prediction that this will be the one, because no one knows which is going to be the one, but it's about managing your risk so that when you are wrong, you lose 1% or you lose 2%, right? You keep your losses small, so eventually when you get it right, the profits from your winning trade will far make up from the profits or the losses of your small losing trades. And it's like anything in life, right? So if you're in sales, you know that the greatest salespeople, they don't close every sale. Right? Out of 10 people, if you're selling insurance, only 2 will buy or 3 will buy, 7 will say no. And that's fine. You get 7 rejections, that's fine. But the 3 that buy insurance will make up for the time you spend on the 7. So in trading, you got to have the same mentality, the same attitude. You got to think statistically over time that you will make money if you follow the rules and manage your risk, and not place your bets on this one trade that you think is going to make it, because no one can predict the future. And that's how we as professional traders and investors, we approach the market. All right. So in this scenario, if this were to happen, for example, it would mean that you have 2 losses and 1 win. So what's your win rate? Your win rate is only 33%. So don't think you need a win rate of 100% or 80% to make money. Even if your win rate is a terrible 33%, you can still make money consistently if you cut your losses short and let your profits run. Of course, in reality, my win rate is a lot higher than that. I can tell you that for my investing win rate, my long-term investing win rate is over 90%. My short-term trading win rate's about 50 to 60%. Yeah, I'm only right 50 to 60% of the time. But when I'm wrong, I lose $1. When I'm right, I make $1.50, $2. So that's how I generate profits consistently. Now, so the GXC is an ETF that you can use to track the overall Chinese market, Shanghai market, right? Now, you can also take a look at another ETF which I use to track the Hong Kong markets, and that's EWH. And you can see that this has already rallied quite strongly, right? So this was a downtrend, and boom, this was a rally. I got in here, making pretty good profits on that one. If you watch some of my previous videos on how to get rich in stocks by being greedy. So in China, there are some companies which I love, right? They are the tech giants. Now, remember that in the US, the four the four strongest companies, all right, we call them the FANG stocks, FAANG. And these are the technology stocks, right? So you've got Facebook, Amazon, Apple, Netflix, and Google, right? So in the US, we call it the FANG stocks. These are the 5 pillars of growth in the US. In China, it's the BAT stocks that are driving a lot of Chinese growth. Baidu, which is the number 1 search engine in China, Alibaba, and Tencent. And I've spoken quite a bit about these companies in my previous videos. Do revisit those videos. And I said, I love these 3 companies. They are dirt cheap right now because of the trade war, and it's a great time to accumulate once they reverse their trend. So if you look at Tencent, again, this is the one that's listed on the US markets. And you can see this was the result. It's a 47% drop because of the trade war and because of some of the temporary regulatory problems that they had in China. Okay, so it dropped all the way from $61 to $32. That was a 50% discount to the stock. And again, on a downtrend, you wouldn't touch this stock. All right, and you can see over here, this was a reversal. Can you see the reversal? From lower highs to higher highs, from lower lows to higher lows. And again, once it crosses above the 50 moving average, once the 20 crosses above the 40, boom, that's a clear uptrend. You want to get in for the ride all the way back to 61, 70, 80, right? Trust me, this company in the long run, it will double, it will triple. And it's a great time to get into this company, Tencent. Tencent, by the way, is one of the largest tech companies in the world. It's even bigger than Facebook. And as you know, some of you may know, in China, Facebook is banned. All right, WhatsApp is banned. Uber is banned. Okay, so in China, they don't use WhatsApp, they don't use Telegram, they don't use Facebook, they use WeChat. Right, WeChat has 1 billion users, and WeChat is basically Facebook plus WhatsApp plus Twitter plus Uber all rolled into one. Right, so it's a fantastic company, and this company is the biggest online gaming company in the world, bar none, right? So this was a great time to get in, and I'm already making some pretty good profits on my Tencent holdings from there. The other one which I talked about quite a bit was Alibaba. There we go. So Alibaba, there was a downtrend. This was the first reversal, which was a false reversal. It made a double bottom. You can see the resistance over there, support over there, and now it's making the second rally, right? So this would probably be the one that will take it back up. So I'm already in this. I entered over here. It did a double bottom, and I re-entered over there. The third one I'm watching is Baidu, but I've not bought this one yet. Why? Because you can see it's clearly on a downtrend. Clearly on a downtrend. It is still below the 50 moving average, and it's still making lower highs and lower lows. So I'm waiting for a reversal to get in. I'm not getting in yet. So again, notice as an investor, as a trader, you get in when you see very clear changes in trend, and you stick to the rules, you manage your risk well, and that's how you make phenomenal profits in your portfolio. So this is a quick update about what's happening in the markets. So again, in the US markets, I'm short-term bullish till we reach that next level of resistance. If we can cross it, then we're in a new bull market. But if we can't cross that level and we reverse back down, I'm going to short the market and look for a double bottom in the US markets. And for China markets, I think that we are more or less bottom. It looks like we've bottomed, and it's now looking like a great time to start accumulating for great growth ahead in the China markets. This is Adam Khoo. If you have questions, leave them on the comments, and I look forward to seeing you in my next video. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.